This isn't just about funding, it's about finding partners who believe in your vision as much as you do. Whether you're building the next big thing in AI or disrupting more traditional markets, I'm here to guide you through this crucial process. So let's get into it. First things first, research is key. You wouldn't approach a fund specializing in B2B SaaS in the US if you're running a direct-to-consumer business in Brazil. It's like Messi showing up to play in the Super Bowl. It just doesn't fit. Not doing your homework can lead to awkward rejections and might even damage your reputation. But don't worry, there are tools to help you out. Crunchbase, PitchBook, AngelList, these are your go-to resources. They'll help you find investors who've shown interest in similar companies in terms of geography, stage, and investment type. Just check beforehand to make sure they're not backing your direct competitors. Now let's categorize these investors into 7 buckets. First, angels. These are individual, so-called accredited investors, typically with a certain net worth, and they may or may not be industry experts. Ideally, they can offer more than just money, like valuable connections and insights. Next, we have venture capitalists, VCs. Here the categories are as follows. First, local versus global. Local funds like Kasek, Monashis and VALOREO in Latin America, or Beko and Venture Souk in the Middle East have a strong belief in emerging markets and don't have to be sold on why the region is interesting. They have a local presence and understand the local dynamics. Global VCs, think Sequoia, Andreessen or Founders Fund, bring international prestige but might be less committed to emerging markets in tough times. There are also other global funds called crossover funds that invest in both public and private companies like Tiger and Co2. Then you have sector focus. Niche-specific funds like Ribbit and QED for fintech or DCG and Pantera for crypto offer deep industry knowledge, and generalist funds like again Kasek or Beko are more flexible and often follow emerging trends like B2B SaaS and AI in 2024. Lastly, you can distinguish by stage. So you have early stage funds, they focus on initial growth phases, while late stage investors, or so-called growth equity investors, aim to scale mature companies. Think here of funds like El Keratin, which we also had on board, or General Atlantic. Some, however, have flexibility to do both, to invest early and late stage. The third category is corporate venture capital. Think of corporate investment arms of big companies like Visa or Nubank. So if Nubank wants to invest in a small startup in Brazil, they have their own investment arm to do that. They bring in a lot of expertise and they can potentially open doors within the industry. And on top, if you want to sell your business to them in the future, that's already good to have them in the cap table. One way to also get the similar route to exit is to bring on board as an angel investor, basically the founder of a leader in your industry in a different market. Next, we have family offices. These are the investment holdings of ultra high net worth individuals. They have dedicated teams to deploy capital. They usually have a very flexible mandate as they are not a fund and range from early to late stage. Let's also cover sovereign wealth funds. These are state-owned investment funds that manage the wealth generated by the government. They typically have much larger AUMs than the other type of investors, with hundreds of billions of AUM across asset classes. Think Saudi Arabia's PIF, Mubadala and Adia from Abu Dhabi, or Singapore's GIC and Temasek. They're heavyweight players with broad investment mandates, doing everything from real estate, infrastructure to venture capital. Note, they work hand in hand with the funds at times. For example, PIF is an LP in SoftBank, but could also make direct investments into companies. So when it comes to choosing your investors of choice, consider the following. Number 1, stage. If you're raising a Series A, you can either talk to an early stage investor or you can talk to a growth investor that can get early too. The benefit of the latter is that they can support you in your following rounds. So if you're bringing on board a long-term partner, they can basically help you not only now, but also in the future. On the downside, they force you to grow very quickly so they can put more dollars at work in your Series B, as their incentive to invest in the Series A is the option to invest more in a later round. Next consideration is what they can bring to you. What is the value add? They can either be just, let's say, big sexy logos, think of your CV, just having a nice university there, but without the actual knowledge. Or you can get investors that have real insight and get strategic value. So think of things from bringing you business, connections to other funds, partners, or strategic advice. The two are not mutually exclusive. Next is founder-investor fit. Presumably you want smart money. You want your investors involved, in the sidelines, supporting you, but many times you may prefer more passive capital, money without having the investors involved if you prefer to run the show more independently. I've had personally both types of investors and there's value in each, so it really depends on what you're looking for. So how could your journey look like? Let's start with a pre-seed round. If you're an inexperienced fundraiser, you should start by raising from friends and family first, and you should leverage your network to bring on board angel investors that could add value, primarily in the form of introductions to institutional investors in later rounds. If you're an experienced investor, you can basically skip this stage and raise from seed stage funds straight away. And then you can rather complement it with high quality angels and friends and family members who you want to add. Next comes the seed round. Here you want to add high quality institutional investors. You need to have a lead investor. Note that family offices don't lead, and there are many VCs that don't either. Here you want to go with a high profile early stage fund that is reputable in your region, say SoftBank LATAM or Big in the Middle East. Securing a strong lead allows you to add other following investors. If you can get a second top tier VC on board too, this would be great, as it will create competitive pressure for the next round. If you're considering an exit in the future, you may want to add a strategic investor here too. This is because at this point, the valuation is still low, hence providing interesting upside, plus they can give you useful guidance to your startup early on. If you don't have any high profile angels on board yet, this is a good moment to add them into the equation. So next stop, Series A. Now you've been executing on your startup and most likely have some sort of product market fit. The type of investors you want to get in here is similar to the seed round, but typically even more focused on institutional investors. There may be even some later stage funds that are interested in investing a smaller stake now to get their foot in the door, with the potential to double down in the Series B. At the Series B and above stage, you will most certainly have institutional capital within your cap table. Your existing major investors, meaning the VCs that are backing you, will likely invest a pro rata and fill part of the round. However, you should focus on bringing on board at least one new and strong growth equity fund with deep pockets. They will support you in the later rounds, and you can continue to grow the support network around you. Here's a tip. As you're raising your round and talking to investors, you should get some reps in with your second tier choice of investors first. Don't tell them, of course. This allows you to refine your pitch before you can talk to your first choice investors. You don't go play against Roger Federer in your first match. You need to warm up with others beforehand and get the reps in. At that point, you not only have a more refined story, but you also be able to say that you're in active conversations with other investors without mentioning by name. That's it for today. Thanks for watching. If you found this valuable, please share it with others that may benefit from it. Make sure to like and subscribe to our channel, and I'll see you soon in LATAM.